From the morning reading, financials break out. The Q's poised for breakout. The spider bounces inside the triangle. 7 of 10 sectors moved higher on Wednesday. XLF, XLE, and XLB were the strongest sectors, while XLRE was the weakest sector. Oil futures rose 51 cents to close at $49.70. Brent strengthening compared to the prior session as advancers led 1843 to 1182 on the New York Stock Exchange and led 1921 to 880 on the NASDAQ. And the S&P 500 snapshot, a modest midweek gain. U.S. equities had a fair amount of economic news to digest. On Wednesday, the ADP employment report was worse than expected. 154,000 new non-farm private jobs was below forecast and the second lowest number in 41 months. And the trade deficit was a bit worse than expected, but the bad news is good news. The S&P 500 opened its intraday low and rallied to its morning high shortly after release of the massively strong September ISM non-manufacturing report. At least for the next few minutes, good news triggered some selling. The 500 stuttered in apparent confusion for about 45 minutes before resuming its trend higher. It hit its 0.63% intraday high at the threshold of the final hour of trading and closed the session with a trimmed gain of 0.43%. The yield on the 10-year note closed at 1.72%, a 15-session closing high. Also in the morning meeting, margin debt declined in August. The latest figures from the New York Stock Exchange show that debt has dropped on a year-over-year basis again, which usually results in below-average future returns. But the growth or lack of it in debt has trailed the growth in stocks by so much over the past 6 months that it has become extreme, normally a sign of excessive pessimism. While it could be argued that it's a contrary indicator and a good sign for stocks, past instances haven't been that bullish. Utilities got hit again. Wednesday's loss marked the 9th straight down day, tied for the longest move in more than 30 years. The Dow Jones Utility Average hasn't suffered 10 consecutive down days since 1979. Like we saw with violations of its 200-day moving average, long streaks of down days tend to indicate severe negative momentum that has continued for the next month or so. A sharp rise in interest rates has slammed rate-sensitive issues. Among the ETFs that are followed, the list of pessimistic extremes is dominated by funds impacted the most by rising rates. The optimism index on REITs is about as low as it gets, at a 2. It has been that low 37 times in the fund's history, leading to rallies over the next 3 to 5 days 25 times. Even though it's twice as likely to rally as fail, some of those falls were extremely large in 2008 and 2011. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model the best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:16 a.m. Mountain Time, and I'm recording this in preparation for the market day of October the 6th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, we had a little bit of weakness. None of the 4 broad market U.S. indices were much from scratch, though. And on crude oil, you're just above scratch. Euros down about 0.25%, bonds up just above scratch, and gold down just below scratch, almost 0.25 point. Hong Kong is up about 0.7%, Japan's up about 0.5%, Germany's down just below scratch, and the United Kingdom is up just above scratch. In terms of macroeconomic reports for today in the United States, you have unemployment claims, the weekly variety, and the natural gas storage report. Looking forward to tomorrow. You have the monthly non-farm employment change, the employment rate, and FOMC member Fisher and Mester and George all speaking tomorrow at various times. And that looks to be it for the rest of the week. In terms of current volatility conditions, short-term VIX currently at a 12.03, skew benign at a 121, IV percentiles relatively low, the S&P at a 23, the Russell at 11, NASDAQ at a 19, and the Dow at a 23. After so much volatility, we've now had 3 trading sessions in a row where we've not achieved a standard deviation size move. Come pretty close a couple times, but when it's all said and done, all these moves, and we'll go to the charts here in just a second, we're within 1 standard deviation across all 4 indices of late. In terms of those charts, when we see this apex in this symmetrical triangle is getting really, really far in. And there's 1 or 2 outcomes to this. One, we either break out, either bullish or bearish out of this apex, or the pattern fails and we go into a horizontal pattern, which is more of a range. And you know, it's I'm not sure what the probabilities of failure of the pattern are, but certainly most of the time we don't get this far into the apex, so I'm starting to suspect that we may have just simply sideways consolidation. If we don't break out of this triangle in the next session or 2, it would seem that that's the most likely outcome. In terms of which way it might break, we are decidedly neutral. Most of the time when you come into a pattern like this, you look at what it did before that, and it was bullish coming into it, so you would expect a bullish breakout. That being said, we're decidedly neutral. We have, first of all, a symmetrical triangle, not any ascending triangle. That degrades its potential a bit. And then you're smack in the middle of the cloud with a lot of this churning action going back and forth. We've had a bit more volatility of late, but it's all arrived at nothing. We've all been with really pretty much inside this one candle here from 9-9. So bottom line is that it could go either way. We'll look for other indications as to which way it might go. And when we look at the Dow gives us nothing. It's just as decidedly neutral as you could get, other than what it did coming into the pattern was, of course, intermediate term bullish. In terms of the NASDAQ has been the most strongly bullish coming in, and has a recent 52-week high. And this pattern here, while you could call this a bit of a bull flag, it's now basically degraded into a sideways consolidation and probably looking for a horizontal breakout, horizontal flag type of pattern. That would be the expected pattern here. While this is sideways, we certainly don't have the problems of being inside the cloud and some of the other issues that we saw with the ES. So the NQ would tend to tell us to expect broad markets to move to the bullish side. The Russell would also give us a similar sign. While it's in a sideways consolidation pattern and has a 52-week high not too far back, it is also above the cloud and, basically is battling overhead resistance. This is kind of that definition of that market phase 4 kind of activity. Many of these patterns up against overhead resistance and kind of chattering along in that pattern. The other markets, gold, of course, has been crushed by a very large dollar move a couple sessions ago, and you see it broke out of its ascending triangle. But remember, it was inside the cloud, which kind of neutralized some of the power we had expected that. The other thing that was going on here is we've seen several undercuts, and most notably this one here, where you had a bullish breakout and then it came down, undercut everything, and then surged back up. And while this is a very, very bearish kind of price action here and is breaking down, in a cloud breakout to the bottom side and so forth, I'm still somewhat suspicious of this, that this might not turn around and rip right back up and set, a breakout pattern above the cloud and above these recent highs. And that's because gold has had this pattern this year of resolving itself after very complex consolidations and even, in quotes, breakout or breakdown violations, just to turn around and set up another leg. So I'm still suspicious that this won't turn itself around, but certainly this is a serious fault in the pattern. In terms of bonds also impacted by the dollar a couple sessions ago. Big move down, as also with XLU. And we talked about XLU in the morning reading. And look at this pattern here. A very serious breakdown. We're well below the cloud now, below all the key moving average lines. So, we are at some pretty interesting support here that goes back into April. But if that starts to break down, it could very easily fall all the way down into the lower 40s without too much of an issue. So just kind of keep that in mind there. So several of these interest rate sensitive markets have certainly been having trouble of late. Now, on the flip side, some of these others, retail and so forth, has started to gain a little bit of strength. It's still inside the cloud, though. But still starting to make seemingly something of a move. And of course, crude oil, clear breakout. We talked about how we expected that this would have this retracement, came down to the 61% fib retracement, kind of chattered around that area in the cloud and so forth, but eventually started resuming this move back up. And look at the number of candles here. And not only did it make the move back up, and we talked about, potentially taking some partial profits in front of this area. It didn't hesitate there very long. You had a close that basically stopped right there, but then the next session went right through and closed above, and then has followed through so far today. So this is likely heading up to the 51.67 area. If you're still in this trade with a partial holding, you probably are going to want to target that, say 51.44 or so, to be able to exit the rest of that position and probably be pretty happy with that, because at that point it's going to be up against a 52-week high, and you certainly would have erased the probabilities of going much further past that. Probably best to look for a strong exit and then look for a re-entry point off a new bull flag pattern to be able to reset a new trade. So very interesting move on crude oil. And then let's go to the VIX. VIX has had, certainly some volatility of late, but ultimately it's still down here in this low area, and right now is playing below, about a 13.5 kind of area. Let's go ahead and go to the daily report. We continue to see more evidence of this intermediate term phase opinion being in market phase 4, this up against resistance kind of area. That's pretty well substantiated at this point. Our three market timing signals are kind of chattering a little bit in some cases. In the first case from IBD, the confirmed uptrend signal is bullish. That one has been fairly consistent here of late. GMI index also fairly consistent of late. That buy signal has been in place since 9/22. Note that the more sensitive GMI 2 is now an 8 out of 8. The one that's been chattering is the stock charts decision point scoreboard. We do have a new signal up in the most recent, and you see the NASDAQ has now just about created a stack between the short, the intermediate term. Only the long term is still giving us this mixed signal. But on the flip side, you got the Dow that's practically giving us a stack going the other way with this neutral to bearish activity across the short to intermediate term with the mixed signal on the long term. With the S&P 500, you got the larger of the group with the 100 You know, as well as the 500 showing intermediate term bullish action, as is the NASDAQ. So 3 out of the 4 are bullish on the intermediate term. But again, this kind of short-term chattering, this long-term indecision, this is pretty messy here. And certainly while we've been looking at the price patterns and we've been looking at this ascending, or this actually this triangle, the symmetrical triangle on the S&P 500, it's been choppy, and this really doesn't tell us that it's going to be anything other than choppy in the foreseeable future. In terms of position sizing opinions, both are still on their models at 100%. Intermediate term market posture, also another cause for the chatter. This has been flipping back and forth in recent activity, going to strong bull to weak bear. And on the S&P, and you see if it drops below 50, it actually would be a strong bear, much like the Dow currently is set. Russell also at a weak bear. At the same time, the NASDAQ still holding on to its severely strong bull intermediate term market posture. This is all up against a bullish sentiment line, though that sentiment line has been weakening. It's still in the upper reversal area. Hedge warning status through all this, I've remained at a level 0+, normal with some cautionary aspects through all this chatter of late. I was tempted at one point to go to a level 1, but while we threatened to break diagonal support, and we did kind of head poke both, above the triangle and then poke just below the triangle. All the closes have been within the triangle. So we really have not broken any kind of price patterns of late. So I've continued to remain at 0+, but it wouldn't take much for this to go to a level 1. So just be kind of aware of that. I'm mostly waiting to see if we should have a breakdown from that symmetrical triangle and to start to see some of these market timing signals start to break down as well. So a number of inputs here which could easily degrade and start to increase the risk levels in our market condition. In terms of strategy opinions, we've held on to all 3 of the strategy opinions of late. Nothing has changed here in recent sessions. Option income strategies. The VIX is acceptable to initiate new positions. Just be aware of this potential for a breakout in either direction in the short term. Cover calls and put selling both still with this kind of defensive structure of being able to initiate new positions, and yet at the same time with a 2-to-1 ratio of in the money and out of the money, 2-to-1 ratio of low beta, high beta positions. Also remember from the beginning of the week I mentioned that nothing came through in my normal screening process as an appropriate watch list candidate for covered calls this week from my usual process. So that itself is something of a warning as well. From the individual warning areas, you see in the volatility group, only the S&P distribution day count being high is currently flagging. In trend base, you got that weak bear. But then up against the intermarket risk aversion indicators, they've all now turned risk on. So really, there's very little red here. So, another reason why I have not gotten terribly excited about elevating the risk level. We just seem to be in a sideways consolidation pattern until proven otherwise. And many of these indicators, which look at the markets from a whole host of different perspectives, are just basically in kind of a benign setting. So kind of keep that in mind. Also relatively benign is the sentiment indicators. There's nothing really flagging here in all 4 of these market looks. And then in the fear and greed index, it's just about as perfectly neutral as you can get at a 49. When we look at specific market by sector, you can see the financials have been universally positive in their action of recent, and especially yesterday here, all but 3 companies were in the green yesterday. Energy also much the same story. In fact, if you look at this, who's up here at the top? These are all the higher beta kind of oriented companies. So again, if we were deteriorating, we would often see, these down here in the red they would be the ones in the green. Consumer staples, utilities, telecom, real estate, these would all probably be in those more defensive sectors, the ones that would be turning green. So much of this money has been rotating out of defensive sectors and out of those long bonds into these higher risk areas. They've also been rotating out of interest rate sensitive products into other areas of the market. So that doesn't tell us that there's an awful lot of concern by institutions at this point. But we continue to see this mixed signals, and we look at the market postures by sector. We see pretty much a Christmas tree here. Though there is some alignment, of course, with the ones that are down: utilities, consumer staples, telecom. Again, with that action of the moving away from the defensive sectors into those higher risk, higher beta areas. And percent change, you can see the performances here yesterday. Telecom and real estate certainly were the big losers. Fair amount of red on the 5-day, a fair amount of red on the 1 month, and some pretty significant red on the 3-month performance on a couple of these sectors. So kind of keep this in mind and start looking for those pockets of best consistency. Certainly of late, financials and energy have probably been the model of best consistency over the various time frames and kind of holding on to actually some movement. Okay, that's probably enough for today. Let's go ahead and we're a little over 20 minutes. Hit the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the disclosures down here at the bottom for the full set of disclosures. We'll be back here for tomorrow's session from Falcon Global with the market preview. In the meantime, manage your risk, and everything else should pretty well fall into place. Go learn something, and good trading.